Hello, everyone, and welcome to Economic Deep Dives, the podcast that dives deep into key economic drivers of financial markets. This week has been a hell of a ride. After Liberation Day, Trump has announced the retaliatory tariffs, which would raise the average tariff rate of United States to a level unseen in more than a century. This logically has led to a very large pessimism in the economy, and we've seen the S&P 500 tanking more than 20%, which in technical terms would mean we're in a bear market. This is also reflected highly in the investor sentiment, with most investors considering themselves pessimistic or bearish. And if we look at consumer sentiment, we in March we hit second time all-time low in terms of consumer expectations, and the lowest expectations in terms of consumers expecting to be unemployed in the upcoming 5 months. This, of course, is horrible for markets. However, the narrative changed when on Wednesday Trump came and offered relief to the market by postponing for 90 days the tariffs on every country except China. However, there has been a clear trade war declared on China, as the tariff rate from United States to China is 145%, and China retaliating in full. So it is close to 600 billion trade relationship between these two countries, and it's definitely very negative for stock markets. However, today, as a guest, we have a bull, someone who's more optimistic in this volatility. So maybe you can tell us a little bit about your perspective, Jurek.
First of all, hi everyone. Thanks for having me, Barak and Joel. It's a pleasure to be here. To start with, of course, I would like to quote John Templeton with famous saying that the bull market emerges and starts on pessimism, grows on skepticism, and dies on euphoria. Well, I would say that we are nowhere close to being in an euphoric environment. To be absolutely clear, I would say we're very more than in a in a pessimistic scenario, which can be clearly seen in the fear and greed index hitting almost levels unseen since COVID. At the very bottom has been sticking around 3 points. In an extreme fear point, we have record levels of companies that are trading below their 200-day moving averages. We have a lot of demand for puts. We have a very high VIX, which is actually having its streak of closing above 40 points for 2 days. That has been only seen in GFC and COVID, which is clearly absolutely extraordinary, which we even count and calculate the expected volatility from the current VIX index for the upcoming month. We can clearly see that this is absolutely abnormal, because then it prices in almost 3% intraday moves for S&P 500, which is absolutely insane. So we are clearly living in an environment of extended volatility. But you ask why I'm optimistic in this scenario. Well, to start with, of course, I quoted John Templeton. There's also saying from Buffett that you're buying when there's a blood on the street. And from the overall perspective, if you look at the investor sentiment and the positioning on the market, everything suggests that it is extremely conservatively allocated and everybody is bearish. And from the contrarian point of view, that's usually a great sign for the market over the mid to long term. From the backtests that you can clearly find in some portals like Sentiment Trader, for example, that provides a great quantitative data regarding the backtesting of how did S&P 500 performed in the scenarios where VIX was on such elevated levels, or for example when the consumer sentiment was so low. Then from the contrarian point of view, I would say we have an amazing secular tailwind that is being driven from AI, and we will also dive into AI later on, which is also a big reason of my bullishness. We have record levels of bearishness among investors. We have huge outflows from the market. We have record levels of hedging. We have net exposure of hedge funds being on their lowest levels for the last 5 years. We have CTAs that are net short for the first time in the years. Everybody is bearish, and of course the recent market drawdown can be also, of course, in most cases, in the most scope can be explained by not a of course not a, you may say that it's for some extent also fundamental reason, but to a big extent it was just a huge and broad-based margin call, and the level of the sell-off was not caused by individual investors, but it was caused by the over leveraging in the market, and that was needed to take down. And of course, in such an environment, you clearly see exaggerated moves from the indices, and the underlying value driver for S&P 500, which I clearly still believe is AI, and this secular tailwind for tech companies, just got a huge relief from the tariff exemptions on Saturday, which I do believe is extremely bullish, and we definitely see some rebound on Monday from the tech stocks. I would say Apple and all the semiconductors and hardware manufacturers. And I think if the market is getting a relief, you can clearly see the one step in the right direction from the policy that is still taking into consideration what Wall Street is saying. Apart from what Trump used to say, that he doesn't look at the market, well, clearly he does. He used to quote Dow Jones in the past. I think he still really cares because of how market is basically reflecting the short-term conclusions of his policy.
I completely agree with you with the fact that we should buy whenever there is all this fear, all this conservatism, and stocks are at its all-time low. But what I also think is that there needs to be an incentive to think that they are prone to go high again.
Mm-hmm.
My whole point with this is that I do see some stocks like technology and all these, what you're mentioning of AI, that are now getting tax exempt with some kind of incentives. But recent research or news have also found that, for example, the consumer would be impacted by an increase of purchasing needs, let's say, of 4.7 thousand. This is a substantial increase, and it adds a lot more rather than only technology. My whole point with this is that I see how this tariff exemption is a relief, and we see that the only sector that was saved in the tariff China of 145% was the technology. And the way I see it is that technology and US is very loud. So like the impact of US technology stocks is very important. It's one of the performance drivers of the US. And instead of for me seeing it as a very bullish call, I see it rather that for the technology, indeed it is bullish. For the economy, it might be a bad indicator, because it could be the case that what the US is trying is to release some noise of these tariffs and all this impact by saying, okay, we're cutting these technologies, which move a lot, like the stocks, and it's like what most people take attention to. So driving away the fact that other products that are also super reliant on China, such as shoe production, clothes production, some basic goods that you need, will still be tariffed. So what do you think of this approach? I see that you mentioned that AI is one of the key drivers, but of the future economy. But what do you agree with this statement that maybe it's mostly to lead the noise somewhere else rather to just incentivize the manufacturing? Is it because of fear that maybe you can just not create a supply chain in the US right now?
Yeah, of course you cannot. And I think from the geopolitical perspective, there is nothing more important for the US than winning in AI. And the tariff rates that were announced in the Liberation Day clearly made the US the most expensive place in the planet Earth to build data centers. And I think a lot of technological lobby from the Silicon Valley that was present on the inauguration day of Trump as well made them realize that it's just not smart from the strategic point of view. That's why you have those exemptions. But overall, I would really be careful and start to do not take anything that Trump says at face value, because a lot of what happened throughout the last week really showed us that I don't really think that's still the topic of the debate, and that's still debatable, of course. You agree with me, that the whole narrative that is being put in the media is the end goal. That is still a main negotiation tactic to renegotiate the new trade agreements with their partners, and also to, of course, hard China to that extent that it can, to some part. I don't believe that the strategical importance of reshoring shoe manufacturing or clothing manufacturing is essential for the US. And I also don't think that this is geopolitically risky for them to do that in Vietnam, for example, which is closer ally than China, definitely. And I do think that clothing will get impacted a lot, and that will be reflected in the CPI reports going forward. So if I were to speculate, I would say that the next subsector that will be exempted from tariffs will be clothing and apparel. But overall, I think this is the way. Of course, nobody knows actually except Trump what he really wants to accomplish. But we should be really looking at that from the perspective that maybe what Trump wants to accomplish just got really interrupted by the occurrences on the bond market. If I were to speculate, I would say that his recent shift in the narrative was not caused by the decline in equities, but it was forced. He was almost forced to make this shift with the rising yields and also with the, maybe to some extent, decline of dollar. But of course, this is some second order effect that he wants to accomplish with that. But overall, the rise in yields was really problematic, and to that extent that it happened throughout the last week made it really, really difficult for him to continue with his policy. And I think he was just convinced by his Secretary of Treasury, probably Scott Bessent, just got more influence in the administration. He was always more conservative with the approach for tariffs. And why is it bullish? I would say the bullishness reflects the fact that throughout the last week, especially at the very beginning of the week, the market was almost pricing the worst case scenario in the evaluations because everybody got completely panicked. Everybody saw those rates from the Liberation Day, and they really started to discount the worst case scenario. And now we are clearly seeing that this narrative is being weakened. And I think the shift for hardware, I think that shift for iPhones and semiconductors is a step in the right direction. And overall, it's a beginning of the end. Maybe that's wishful thinking. Beginning of the end of the trade war, which is, of course, extremely bullish for tech. And that's a huge value driver of the overall market.
I have to say, there's definitely a lot of aspects here to consider. I think I would first start by addressing the Vietnam. So you said that US wouldn't be very happy to have a lot of inflation on more basic goods. That's why you would see some exemptions, or even maybe like more relief on other Southeastern Asian countries. But what we've seen in the first term of Trump's presidency is that because of these tariffs, a lot of the goods exported from China tend to be rerouted through more tariff-free countries like Vietnam. So I think that's also a large reason to why we see the high tariff rates on the Southeastern Asian economies. And yes, I agree completely. There's definitely not a large need or a desire from Trump to bring back the shoe manufacturing, but industrialization, I think, is something that he has been mentioning a lot, specifically in the military purposes, where China has been producing more naval ships than America has done since the Second World War, just in the last year. So there's definitely a lot of demand to reindustrialize and produce and manufacture in the US. But I think the narrative that actually shakes a lot of the markets, because you made a very strong technical perspective. You're saying, okay, VIX being at so elevated, this is not sustainable. Historically, when this happened, like this was the pessimism born the bull market. However, there is a very big fundamental change in the narrative. And I think this is best exemplified by the fact that I think it's for the first time in history where stock market significantly contracted, and then the yields actually rose, they didn't decline. Because usually when the stock market declines, that's more of a contraction in the risk appetite. So there's a flight to safe haven assets, and what's the risk-free asset? Is the Treasury. However, there was a flight from the Treasury as well, because in reality, in aggregate, what we saw is a flight from the US as a strategic geography into other economies. And especially that's highly understandable, as China is the largest foreign holder of USD denominated assets. And given that there's a 145% tariff, I think the outlook for business in the United States definitely changed. And considering all of this information, I think there's definitely a strong argument to see as the economy as a whole to be a lot more bearish, given that a lot of the, let's say, growth was fueled by the value of the dollar, which has declined, I think, against euro 10% from its one-year high. And it's artificially boosted just based on it being a reserve currency. But yeah, the narrative is changing. So I think there is a lot to take into account, and it's not just a technical drop down, but it's really a big fundamental shift in terms of the supply chain of the world and USD supremacy.
A lot of stuff to talk about. First of all, in terms of the narrative shift, I would say that the whole narrative shift got a little bit weaker after the exemptions for tech, because it is a clear sign to into the right direction and into the if you will, not art of the deal, but art of the capitulation from Trump. And also to talk a little bit about the yields, I would say that this can be explained partially to some extent with a huge degrossing from the funds who were very leveraged also on the bond market. Decline in dollar made it relatively more attractive for European investors to invest in, for example, German bonds that also experienced the rise in yields, especially if you take into account the cost of hedging. There was a really nice comparison chart from Bloomberg that, yes?
But sorry, if I'm misunderstanding, hasn't the Bund yields declined actually? Like wasn't the flight to euro and the Bund specifically what was a safe haven asset on the market?
No, actually, recently yields in German bonds also went up after their stimulus, and on the relative basis, there also the difference between bonds and the treasury yields detracted, and especially if you take into account the cost of hedging. So from this relative perspective, for European investors, it is relatively less attractive to invest into treasury yields from the US comparing with bonds. And also you have, that's also probably one of the reasons, record high share of in the US capital market from foreign investors. And you also had the record selling from foreign investors, usually mostly central banks, that were dumping US assets in the highest pace in the history in the last week. And that's also the data. And also they were represented by the highest share of the overall market. So that was clearly a contributor. But I will also say that for the equities per se, the weak dollar, not necessarily bad. I would even say that it's good, because most of the companies in the S&P 500, they not only derive almost half of their revenues from outside the US on the average level. You also have some companies that derive more, some derive less, but on the average level, it's around 45% from what I recall. And you also have most of your costs in dollars. So from the S&P 500 level, of course, you may say the weak dollar is way more bullish for emerging market countries because they have a lot of debt that is denominated in dollars, and the weak dollar really makes it easier for them to finance their debt obligations. But also, it is not necessarily bad for many companies. You have Amazon, for example, that was experiencing a lot of forex currency losses from the strong dollar. So now it's going to reverse. You have Uber, for example, who has more than half of the revenue from outside the US, and their costs are mostly in the US. And also, you have a lot of forex exchange losses. So from the equities per se, it's not necessarily bad. Probably rising yields are, of course, more of a bad indicator because of a relative attractiveness of the valuations. But I would say that the outflow from the US was probably more of a short-term sentiment driven rather than a fundamental shift. But of course, this is still debatable, and the long-term effects of the chaos will be seen in the coming months and years as well.
While I completely agree with you that maybe this weaker dollar might give room to more benefits, there still needs to be a demand for the product. We see JP Morgan, I don't know if you've seen, but increasing the chance of recession up to 40%. And I think that we $60, which would be that there's no recession, I think only 10% assumes that the US will get back this bullish mood. And unlike the other 30, is that we will just stay in line. So like we will not see this bullish reasoning again, but rather just stay.
And Goldman Sachs is even more.
Yeah,
bearish,
55.
like 55%. Like
yeah, actually, they really reevaluated their expectations after the new announcement in terms of the tariffs. Very volatile, and of course, it is really narrative driven and very difficult to predict. I still remember. I always take those forecasts with a grain of salt because I still remember in 2022 when the consensus on the Bloomberg was pricing in 100% probability of a recession, and of course, we didn't experience any recession. So this always needs to be taken with a grain of salt.
While I completely agree, I think that consumer sentiment tells otherwise. We're seeing the lowest point until now, and at the end of the day, who needs to consume is the consumer. And a lot of these companies that you were mentioning, such as Amazon or like these companies, rely on the fact that people have the purchasing power to do so. A lot of times there's purchases that are not really necessary, and maybe we would go towards an economy of mostly purchasing things that we actually need rather than just pure capitalism as we've seen it so far. I just think that the purchasing power is the major threat here rather than just the weaker dollar and all these things that we're just talking about, because if there is no incentive for the consumer to buy things, to consume goods, there doesn't matter rather the stronger dollar or the weaker dollar, because at the end of the day there will be a decrease on the market itself, and these tariffs will not only hit US, like it will hit all around the world. We see that Europe is also on threat because of the production of their goods is mostly goods that are kind of expensive. We do not do so much labor that is cheap, rather very expensive things, and there's a threat of also employment and a lot of these things, and that would lead to a circle where there's less employment, so there's less purchasing capital, so there is less demand on goods. So we go to inside a cycle, and I think that's the major threat. I don't know if you have anything to add, Barak.
Yeah, I do. So definitely, I completely agree with the consumer argument. However, I would have to say also maybe for me as a foreign US investors, I have to convert my euros to dollars and then back. For me to break even with the fact that the dollar depreciated 10%, I would have had to make 12.5% on the S&P 500 just to be at 0% return. So for me as a foreign investor, it already makes it very volatile. And the fact that Donny wants the dollar to go down further, that does not make it more attractive. So I do think that narrative for foreign flight of US denominated assets is definitely something to back on.
Yeah, from the bottom-up perspective, I always like to look on the underlying geographic exposure of companies. It doesn't matter what currency they're denominated in, because you can, of course, let's for example point into Booking.com or Spotify. Those are companies that even though are listed in the US and of course make a lot of money in the US as well, majority of their revenue is still derived from euro. And they are clearly going to experience a lot of forex tailwinds because of that. So over the long term, the currencies depreciation have less of an impact as you may think. Like for example, a company called Mercado Libre. That's the biggest technological company in Latin America. Well, the company grew immensely for the last decades, even though they were operating in a very high inflationary and high currency depreciating environment, like Argentina, like Venezuela. and it fortunately didn't made it difficult for them to adjust the inflation currency depreciation levels, even being denominated in US dollar. But from the broad-based perspective, I do agree that this is a risk. But if we also take a step back and talk a little bit about the consumer sentiment, you said that the consumer purchasing power is getting weak. Well, if we do take at face value all the tariffs that were announced, then that definitely is very recessionary. But it's still, of course, forecasting the target levels is absolutely impossible. I do still believe, of course, you may call it wishful thinking, but I do think that eventually this is just scoring an own goal, and it's not gonna live like that for a longer.
But just to answer this, because I think, yes, while they might not have been hit, the tariffs have been cancelled. I think the damage has been done in terms of expectations and sentiment. So, as I said in the beginning, right now we're at all-time high in terms of consumer expecting them to be unemployed in the upcoming 5 months. That already changes your behavior to save instead of spending. What happens to an economy that doesn't spend? It contracts. So while yes, it cancels, it gets exemptions, it still affects inflation expectations and the economy, which in terms makes a self-fulfilling prophecy.
Yeah, so you have also a counter argument for that. For example, that inflation expectations that I would not take too seriously recently, because they were really heavily skewed by the political views. If you
Yes,
look into the Michigan
it's
data,
like,
yes,
it's completely opposite. So Republicans expect like 0% inflation,
Yes.
while Democrats like
So-
8 to 9%.
absolutely meaningless to base your expectations on this data. But overall, you clearly see a lot of disinflationary trends, like oil prices going really down, natural gas as well.
But one very big
Mhm.
inflationary trend is the dollar. Like a 10% decrease that makes it much more expensive for consumers to import, besides the tariffs.
Of course, but if you had like the recently is still a big of a volatility of a forex exchange, we can also see next week a big appreciation of dollar. I would not be surprised at all.
But I do want to say one thing, because I think the dollar has a lot of correlation with the trust market has into this currency and political regime. And I think a lot of the trust, while we've seen exemptions and tariffs being cancelled, I think the trust left with it, and that's largely by foreign investors.
I agree. There's definitely the trust has been damaged and absolutely irreversible at that moment, but still a lot of damage, majority of the damage is still irreversible. That's why this crisis is different than the others. Almost every single crisis is different than the other, but this one in particular, if we compare this decline in the market with other declines in the past, like COVID or FC, this one has been caused by one man, and it can be reversed by one man. So of course, you may say that the market that is pricing in almost the worst case scenario has definitely a better risk reward than it had, but we're still in a completely different environment from the geopolitical standpoint that we were. And I completely agree with that the damage has been done, and the overall influence of these occurrences will be seen for a very long time, and we will probably see some swings in the strategies of their allies in terms of the trade policy. Like, for example, I would not be surprised by European Union being more close with China or with other trade partners. Yes.
They're already shaking hands with everybody every day.
Yes. So I think that's definitely the risk for US. But overall, quote Donald Trump, I still believe that the US has most cards, and from the negotiating standpoint as well. So if you look at China, you may say that, okay, well, they retaliated because they are a dictatorship country. They do not take into consideration, the approach of the well-being of individual people. They have a different set of rules than the democratic countries, so I think they have a little bit of pride to be shown on this overall negotiating levels. But they have a lot more to lose than the US, in my opinion.
I would like to make some points regarding that. The first one is that while you very well mentioned that energy is decreasing in price and like that this could be kind of the inflationary, I do think that let's say that we do not see the whole tariff history. I completely agree. I don't think that the tariffs will stay as they've been proposed, and I think everyone knows that. But I do think that there will be some presence. And I do think that a lot China's power over the US is clearly being underestimated. A lot of small products that are produced in China and then like they're completed in the US, but like the small pieces still come from China. And I think that a lot of basic goods that you might be undervaluing actually could lead to, for example, this lowering in energy price. It can still get offset by the fact that other basic goods are getting offset or like increased in price. And secondly, you mentioned that you think that US has all the cards or like most of the cards in his hand, if I didn't misunderstood.
Yes.
I think that or I have a point like to at least think about. I'm not saying that neither of us have the total truth because we don't know what Trump will say. But I do think that the problem of the US is supply driven, meaning that they need to move all their manufacturing, like somehow, or they want to incentivize somehow all the production in the US or in other countries that maybe have closer relationships with the US. While the only problem of China is the fact that they need to shift their aggregated demand. So like now they are facing a problem of aggregated demand, which is that maybe some of these products that they used to sell, they just cannot sell them in the US anymore, so they need to shift who they sell them to. The good thing is that while I know that the Chinese people domestically have a tendency to spend less, that I would like to flip the coin on the fact that China for the last years has been trying to incentivize the Chinese population to to spend more. And instead of a constraint or a bottleneck, I would like to see it as a door of saying Chinese people can consume much more, and maybe this aggregated demand can actually be fulfilled. So I think that their problem is demand driven, which I see much easier to solve rather than the fact of literally moving years of supply chain and efficiency in one single country, which hasn't developed yet.
Yeah, just to quickly add on that, I just want to show how resilient the US demand is. So 70% of the consumer spending makes the GDP of US is based on 70% consumer spending, but in China, less than half of that. It's 30%. So it's definitely a cultural shift. However, the demographics are also changing. We have a very low birth rate. So there's definitely a lot to inherit for the new generations, maybe much more spoiled and much more willing to spend on discretionary products.
Yeah, in China, you have most of the wealth of people being accumulated in the real estate. You have a huge real estate crisis in China, and also you have huge deflation problem in China. And the government was actually trying to stimulate the consumption throughout last couple of years, and it was not efficient. And I do not think that it is realistic for them to shift the whole consumption domestically. This is very export-driven economy and manufacturing-driven economy, and without a market where they can sell, and definitely U.S. consumer is the single most important consumer in the world, this country will really go into the very deep recession. And from this point of view, of course, this will be very deflationary even more. And deflation is even a bigger issue than inflation for the growth of the economy. So I think China is really facing a lot of problems from that point of view.
So I have a question. You said very deep recession. We're talking about the 500 billion that is exported to. I think China economy is 17 trillion, something like this.
Around that.
Yeah, it's around 5 to 6. However, this can be heavily stimulated by the government, and the government has the powerhouse and the capacity to do so. But why would you see China being in a worse position than the United States, given that demand is easier to create than the supply, which takes years of infrastructure?
Well, first of all, I would say that the Chinese government tried to stimulate the consumption. It was not efficient, and they didn't succeed. So why would they succeed in the next trials? Maybe they will, of course. It's my speculation that they wouldn't be able to consume all the excess capacity they will be having. And this is a country that is very heavily skewed towards being an export-driven economy. So I don't know exact numbers on that topic, but I definitely can foresee a huge deflationary and recessionary problem for China in a scenario of losing the biggest market as the US. But overall, I do agree. It's really dependent on your perspective, whether or not, how do you view the overall situation. I do think that there's nobody who's actually winning in this problem. Everybody loses in a different way.
Yeah, I completely agree with
But you can call somebody a bigger or a smaller loser, but overall nobody actually benefits from that. There is something called comparative advantage that is being thrown away in that aspect.
Definitely.
And that's not very healthy, I would call it.
Indeed. So just to conclude, what are your big winners, if there are any? Should we look at any asset class or any sector, in your opinion?
Well, from the bottom-up perspective, I do focus now on those type of companies that are not only growing and are of high quality, but also are a bit of isolated from the overall noise regarding tariffs. And there are a couple of them. You can say that to some extent, every single company is somehow impacted. But if you look at the reactions from the global markets, you can clearly see that there is a narrative shift in Latin America. A lot of countries there has been experiencing a bit of big inflows into their ETFs. Argentina, of course, but Argentina had its inflows since Milei got elected. Of course, it was the best performing market in the last year. Now we are seeing Brazil that is up double digit year to date. We have Mexico that is also up double digit year to date, Colombia and Chile. And also Mercado Libre, which is the biggest tech company in the region, announcing every single day for last week the big investments in all of those countries that are higher, almost like 30 to 50% higher than last year. So this is a clear differentiator if you compare it with other tech companies, because you can clearly see that in this region you don't have this uncertainty, because the biggest employer and the biggest tech company is basically throwing out money on every single market. So there is less of an uncertainty. And of course, you also had a really intriguing announcement, for example, from Argentina when a few days ago Toyota shifted their manufacturing of EVs from China to Argentina to diversify their supply chain. So definitely there is a big of a shift. I think location-wise, Latin America is well poised, and also platform-driven businesses. I would say those that do not have any product. What for example Uber or Spotify or Booking, those companies are being affected only on a second-order effect of consumer being weaker, but do not experience any cost pressures and margin pressures per se, because they don't own anything actually. So those companies are a bit isolated. And there is a third subgroup of companies that I think will thrive in this environment. And those are companies that are called serial acquirers, like companies that their business model is based on buying other companies. And this is basically their way of growing.
This is the Berkshire pitch over here.
Of course, Berkshire is for some, yeah, you may say that it's the biggest serial acquirer in the world, and they are actually, even though the Apple is performing really badly this year, Berkshire is up year to date. So this is definitely a sign that market is assigning this premium to this optionality of Berkshire to now deploy a lot of capital. But you also have companies like Constellation Software that buys a lot of locally based small software companies that are, for example, providers of public software that do not have any exposure to tariffs, and market declines are perfect for them because the valuations are going down, and their growth rate is basically derived from acquisitions. So the market pessimism is perfect for them. They were thriving in 2008. Actually, Constellation grew their revenue in 2008, which is super impressive. And also the same can be said about COVID. So I think those are quite interesting niches.
Thank you very much, Jurek. I think that we learned some very cool things today. We had a very nice argument. I think that there's a lot of points of view, different perspectives depending on what do you think that Trump will do or what's his next move. I think that changes the whole picture of any argument.
Of course.
I really appreciate that you came and gave us your peace of mind. I think it is very insightful and it changes or gives a bit of optimism to a very bearish environment, even a bit depressing. I would like to say that it's been great to have you here. And yeah, Barak, do you have anything else to add?
Of course, thank you very much, Jurek. It's always nice to see your perspective. I think in general you're very optimistic, but I also really love your philosophy. Bottom-up selection, really identifying the alpha among a lot of companies. Yeah, it's insane. I love your analysis. I love your perspectives, and thank you for coming. Thank you for watching, and we'll see you next time.
Thank
Bye
you.
bye.
Thank you guys for having me. That was a pleasure.